Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson. Today we turn our attention to the revenues that firms will make and then just a brief introduction to profit. Revenue.
Revenue is the amount of money a company brings in from the goods and/or services it sells. Many analysts use the term sales and revenue interchangeably. Companies usually calculate and report revenue for a quarter or a year. Barbara owns a bakery. She earns revenue from the sales of cakes, cupcakes, cookies, and other desserts. In the first quarter, she sold 1,250 cakes at $40 each, 10,000 cupcakes at $4 each, 10,000 cookies at $2 each, and $40,000 of other assorted baked goods. Her total revenue for the first quarter is $150,000. Based on this number alone, it would appear that Barbara's bakery is very successful. However, revenue alone doesn't provide a complete picture of a company's finances. We also need to know how much Barbara spent on supplies, $20,000. How much she paid her employees, $40,000. How much she spent on rent and utilities, $20,000. How much interest she paid on any business loans, $8,000. And how much she expects to owe in taxes for the quarter, $22,000. With her total expenses equaling $110,000, Barbara has $40,000 left over, her profit. But if her expenses totaled $200,000, that $150,000 revenue would be insufficient, leaving her with a $50,000 loss for the quarter. Thus, revenue is important, but it must be analyzed with expenses to provide a meaningful look at a company.
A nice little introduction to revenue there, especially in the context of considering expenses as well, the firm's costs. Okay, so revenue is income that's generated by a firm from the sale of the goods or services it produces. Total revenue. The quantity of a firm's product that have been sold times the price those products sell for. So total revenue equals price times quantity, P times Q. So if a firm sells only good A at $5 a unit, sells 100,000 units within a year, then the total revenue for the firm is going to be $500,000. So a nice easy calculation there. Price times quantity equals total revenue. Price of the good. The quantity sold. Total revenue. 200 times 1,000, $200,000. Average revenue. It's the reverse calculation. The revenue per unit of output is average revenue, and that's because average revenue equals total revenue divided by quantity. Now remember that total revenue equals price times quantity. Total revenue divided by quantity is the same as price. Average revenue equals price. So for example, if a firm has a total revenue of $500,000 from selling 100,000 units of output, then its average revenue is $5. Quantity 1,000, total revenue 200,000, average revenue must be $200. And average revenue, again, that'll be the price of the product. Marginal revenue. Now we've looked at marginal costs in quite some detail, and marginal output as well. So you should be getting an idea about marginal revenue already. Marginal revenue, the revenue gained by producing one additional unit of a product or service. Marginal revenue is calculated by dividing the change in total revenue by the change in output. Marginal revenue equals the change in total revenue divided by the change in quantity. the easier calculation that I use all the time, marginal revenue can also be calculated by subtracting the last unit of output from the one preceding it. So if we take total revenue at 100 units of output and total revenue at 101 units of output, if we subtract the total revenue at 100 from 101, then we will work out our marginal revenue nice and easily. Okay, so total revenue this firm makes at 100 is 20,000, that's 100 units. And at 99, the firm's total revenue is 19,800. Total revenue 100 minus total revenue 99 will give you the marginal revenue for that 100th unit of goods. It must be 200. Key point here, just like with average revenue, marginal revenue equals price if the price charged by the firm for its product doesn't vary. It stays the same. And we'll have a look at that in a little bit more detail. Perfect competition. Key point, first time we've introduced it. Listen up,
What do you
take good
remember about
notes.
perfect competition? I mean, how would you recognize a perfectly competitive industry if you ran across one? In perfect competition, 1, there are a large number of sellers. There are a large number of buyers too, but we won't be worrying about that just now. No individual is large enough to affect the market. 2, the product is homogeneous or identical or non-differentiated. For example, milk. When you go to buy 2% milk at the supermarket, what brand do you buy? If you're like me, you buy whatever's on sale. I have no brand loyalty whatsoever because milk is milk. 3, there's perfect information. It's actually not enough for products to be identical. Everyone has to know that the products are identical. Otherwise, we could be fooled by things like pretty packaging or celebrity endorsements. In a perfectly competitive industry, firm versus firm advertising is useless. All you'd be doing is driving up your own costs, and then customers would just buy from a cheaper competitor. However, you may see industry-wide advertising like the Got Milk campaign, pork, the other white meat, or beef, it's what's for dinner. These kind of campaigns raise demand for each firm's product across the industry. 4, easy entry and exit. Because firms can enter and exit the industry at will, long-term profits will be effective, but we'll get to that in just a bit. For the individual firm owner, the combined effect of these characteristics is that he or she has no power to control price and will earn zero economic profit in the long run. Let me ask you this. If the individual firm cannot set the price, then where does the price come from? Think back to our market activity earlier in the semester. In a market with lots of buyers and sellers, the price is determined collectively by the market supply and market demand. This, then, is the prevailing price for each firm. What happens if the firm doesn't like this price? If it tries to charge more than P-star, all of the customers will go someplace else, so the firm would be forced back down to P-star. If it tries to charge less than P-star, then all customers in the industry will come to this firm. Sounds good, right? Wrong. This firm cannot accommodate the entire industry demand. Costs would skyrocket. The firm would be forced back up to P-star to get rid of some of the customers. All of this means that the firm is a price taker, forced to accept P-star, the market-determined equilibrium price. Note that this also means, because the firm charges P-star regardless of the quantity demanded, that P-star represents the firm's demand as well. Remember that perfectly elastic demand curve from earlier this semester, where consumers are so hypersensitive to price that price is all that matters? Well, that's this market structure. Okay, so you're a producer in a perfectly competitive market, and you have no control over the price that you can charge. Is there anything you do have control over that you can make decisions about? A perfectly competitive firm may not be able to choose its price, but it can choose how much output to produce. The firm owner will choose the level of output that will maximize his or her profits. See episode 26B to see why. marginal revenue equals marginal cost, will always be the profit maximizing rule. So, you're a firm owner in a perfectly competitive industry. You can't choose the price that you charge, but you can select the amount of output that you produce. In order to maximize profit, you will always choose the level of output where marginal revenue equals marginal cost. Take a look at the perfectly competitive firm and see where this occurs. I need to choose output such that marginal revenue equals marginal cost, but right now I don't see marginal revenue or marginal cost. Let's start with marginal revenue. Marginal revenue is the additional revenue that you earn when you sell an additional unit of output. For a perfectly competitive firm, since all units are sold for the same price, each unit sold always adds the same amount of revenue, P star. For example, if price is $5, then the total revenue for 0 units is $0, for 1 unit is $5, for 2 units is $10, and so on. Selling 1 more unit generates $5 additional of revenue each time. Therefore, marginal revenue is equal to the equilibrium price. Note that this is only true for perfect competition. What about marginal cost? Well, marginal cost is actually pretty easy. We constructed the cost curves, marginal cost included, before knowing anything about market structures. Those cost curves are the same regardless of the structure we're operating in. This means that the marginal cost for the perfectly competitive firm is just marginal cost. Remember that J-shaped Nike Swish thing? And now, all we need to do is select the level of output where marginal revenue equals marginal cost. Now, because there are no average cost curves in this diagram yet, I can't actually show you how large or small the profits are, only that Q star will be the best level of output for this particular producer based on the profit maximizing rule. Let's look at just one example of how to find profit using this model, then we'll do more cases in class. What if my perfectly competitive producer is operating in an industry where price is greater than the cost per unit? I can already tell that this producer will be making profits since there's more coming in for each unit than there is being paid out in cost, but let's see what it looks like. Notice that I've positioned the average cost curves below the price line. Where is MR equals MC? This gives me Q star. At Q star, what is the total revenue coming in? Revenue is the price I can charge times the number of units that I sell. In this case, the green area. At Q star, what's the total cost of producing this output? It's the cost per unit, ATC, times the number of units that I sell, in this case, the red area. The amount of revenue, in green, that doesn't get chewed up by the costs, in red, is profit. In this case, I've indicated profit by the blue area. In the short run, this producer earns positive profits. Why do I say in the short run? Because those short run profits attract the sharks. Other outside firms see the profits and enter the industry to set up shop. This causes industry supply to increase, driving the price downward. In the end, the entry only stops when there are no more profits to attract the sharks, until price is equal to average total cost and the firms just break even. In the long run, a perfectly competitive firm's profits are always equal to 0. Next time, monopoly.
Right, such a beautiful little video there that explains the concept of perfect competition easily and in full detail. Make sure you take good notes from it. Okay, perfect competition, where supply and demand in the market meet, where we have the price. Now, in perfect competition, where the competition between firms is not perfect, a firm needs to reduce its price to be able to sell more. That comes from the law of demand. As the price of a good decreases, the quantity demanded increases. So a firm can only sell more by decreasing the prices. So if the firm wishes to sell more of its good, it needs to decrease the price, and that will alter the total revenue figures for the firm. Since total revenue at $5 was $5 times 1,000 goods, $5,000, Total revenue at $4 is now $6,000. Whereas with perfect competition, we've got this perfectly elastic demand curve. The firm's too small to have any effect on the price of the market, no matter how much the firm is producing. Total revenue is determined solely by how much output that firm is producing and selling. It cannot get more than the market price for their product. Let's have a look at some revenue information, some revenue data for firms. So output, no output at 0 through to 6 units of output. In perfect competition, price doesn't change with output. We see that from the demand curve. Price is consistent. Total revenue, price times quantity. The calculation is superbly easy. Average revenue, we are just dividing total revenue divided by price. And we also know that in perfect competition, average revenue equals marginal revenue, which equals price. Marginal revenue, the change in total revenue from producing and selling in 1 extra unit of output. Conveniently, in perfect competition, marginal revenue is the same as average revenue, which is the same as price. So quite a distinctive pattern of total revenue, average revenue, and marginal revenue as a function of output in perfect competition. And if we graph this, we get this flat demand curve, perfectly elastic demand curve, and demand is the same as price, and price is equal to average revenue, which is equal to marginal revenue. So marginal revenue and average revenue stay the same as price. Total revenue, of course, continues to grow as the firm sells additional units of output. Now let's have a look at a firm in a more normal market situation. In perfect competition, firms do have control over their price now, and to be able to sell more of a good, they must decrease their price in line with the law of demand. So the firm has to decrease price to sell additional units of output. So we're looking at a normal demand curve here. Total revenue, we know that that's price times output. Nothing difficult there with the calculations. Average revenue, total revenue divided by price. Nice easy calculation. And marginal revenue is the change in total revenue from producing and selling an extra unit of output. Now we can see here that marginal revenue is decreasing. Marginal revenue is decreasing as the units of output produced and sold increase. And now we get a more normal looking demand curve. So average revenue is the same as the demand, which equals price. Price is equal to average revenue, and that's the demand curve that the firm is facing. Total revenue increases up to a point until marginal revenue goes negative. Any addition to total revenue, which is marginal revenue, that is positive, continues to grow total revenue, but as soon as marginal revenue turns to negative numbers, then that will drag total revenues for the firm down. Marginal revenue can only be calculated after the first unit of output is sold. And as stated before, total revenue begins to decrease as output increases past that point where marginal revenue equals zero. So past the point where marginal revenue turns negative. Now, the slope of the MR curve is twice as steep as the slope of the average revenue curve. And that's because the firm needs to decrease the price on all units sold and not just the next unit. So the firm needs to be prepared to forego additional revenue on the previous units to gain revenue from each of the additional units they sell. And that leads us quickly and briefly into economic profit.
Economic profit is the difference between the revenue a firm earns from sales and the firm's total opportunity costs. It's important to distinguish between accounting profit and economic profit. Accounting profit is total revenue minus the explicit costs of producing goods or services. Explicit costs are things like raw materials and employee wages. This is what most people are referring to when they talk about profit. Economic profit includes the opportunity costs a company loses or gains by making a decision to pursue one avenue towards revenue, thus passing by a different opportunity, which also might have produced revenue. A firm can have a large accounting profit, but no economic profit. For example, an investor starts her own business with $100,000 and earns $120,000 in profits during the first year. Her accounting profit is $20,000, but that same year she could have earned an income of $45,000 working as an employee for ABC Corporation. The investor's economic profit for the year is actually a loss of $25,000. Economic profit often determines whether a firm should enter or exit a market. It's used to calculate total production costs and to assess a company's total value.
Okay, so we have looked at economic profit before, and I just want to revisit it briefly. Economic profit, in terms of the firm's revenues, which we're looking at now, economic profit, total revenue, which we know is price times quantity, less explicit costs, less implicit costs, will give the firm's economic profit. And we're just now going to briefly label the types of economic profit that are out there. So if a firm's total revenues equal its accounting costs plus its economic opportunity cost, then the firm has a normal profit, a normal economic profit, an economic profit of zero. If total revenues are greater than economic and accounting costs combined, then we're talking about supernormal economic profit. And that's positive economic profit. And if total revenues are less than accounting and economic costs combined, then we're talking, the terminology is subnormal economic profit. Why don't they call it a loss? I have no idea, but the terminology is subnormal economic profit. So that's a negative economic profit. And we can see from the subnormal economic profit diagram that a firm can be making an accounting profit if they don't factor in the opportunity costs, but making an economic loss, subnormal profit, once economic opportunity costs are factored in. Okay, we're going to look at this in more detail next lesson, economic profit. Thank you.